Bloomberg Audio Studios.
Podcasts, radio, news.
For Global Wall Street, Steve Eisman, Neuberger, Berman. Steve Eisman, if we get an Ed Yardeni market, which is a melt-up, like he's calling it the roaring 20s, he's got us up 30% out the next 30 years. If we get a bull market of our childhood, how do you adapt to that? How do you adapt to the good times if we get the good times? What do you do?
I don't think I really have to adapt. I kind of believe in good times. You know, the economy is fine. The Fed, at least at this point, seems to have engineered, I don't even know if it's a soft landing anymore. And, you know, the U.S. economy is extremely dynamic. The only negative scenario that I could construct, and it's not my base case, I would just say the probability of it is not zero, is just that it looks like it's possible the U.S. economy is reaccelerating, and then maybe at some point inflation starts to go back up again and the Fed has to raise rates again. That's the only negative scenario I could see at this point.
So where are you, Steve, on kind of your Fed call? What do you think the Fed will do? What do you think it should do?
I think the Fed should do nothing.
Nice.
You know, it engineered something pretty amazing, which kind of shocking to everybody, including me. The economy is good. You know, why would you? I mean, look, the worst case scenario for the Fed would be to actually, I think, cut rates. The economy gets stronger, and inflation comes back. Then you're back into the Volcker situation of the early '80s.
Yep.
Yeah, the best thing to do would be just to pat yourself on the back, declare victory, and say, we're completely data dependent, and if things start to weaken a little bit, they can always cut rates. Otherwise, you know, do nothing.
So is that something, when you say kind of wait, is June waiting, or is even later in the year waiting for you?
I don't know. I think at least till June.
Okay.
After that, you know, they probably do nothing anyway because they don't want to be accused of getting involved in an election.
Right.
Okay. Steve Eisman, we're celebrating Amazon into the Dow. I did a lot of Dow mathematics overnight, and it's so silly. It has a 15% tech exposure, including minuscule Intel, Cisco, where the street is 28% tech exposure as well. How do you approach this massive lifetime overweight in technology? Is there a derivative strategy? Is there a portfolio optimization you believe in?
Well, I do think in overweighting or at least equal weighting tech is something you have to do. But I think there are some themes that are direct offshoots of tech that really should be examined by people that are not technically in tech. So, for example, because of AI and the NVIDIA chips, which consume so much more electricity and are hotter, the grid has to be improved. So there are companies that benefit enormously, construction companies that benefit enormously from that are not tech companies. The data centers have to be cooled even more. So there are companies that provide those type of services that are going to do extremely well over the next couple of years. So there are offshoots from tech that are not technically tech that really should be looked at very closely.
So, Steve, I guess a lot of folks, I'd love to get your market call where you're seeing opportunity here, because, you know, one of the debates that we hear often is just, do I stick and try to, if I'm not there, get to the Magnificent Seven somehow? Or do I try to find some values in other parts of the market? Maybe I've missed that trade. So coming out of 23, when it was such a hot close to the year, what do you think about tech and being a leader in this market?
You know, I think we're in a bull market. In bull market, people love stories. They just latch onto stories. It's what they think about. It's what they dream about. And if you can invest in something that has a story that people can really understand and get positive about, that's something to do. So tech is one such story.
Yep.
Infrastructure is a similar kind of story that's going to last a long time. And there are a few others, and those are the things that I would focus on.
Steve, we got to go to the banks. You've done a lot of work on this, the acclaim of a certain movie years ago and such. The financial integrity of the system, is there a flavor of bank where you think there's value?
I am not worried about the financial integrity of the United States. I actually think it's incredibly healthy, probably healthier than any time in anyone's lifetime. So I'm not worried about systemic risk. There is risk in the banks in terms of commercial real estate exposure, but that's really a regional bank issue, not a systemic problem. I just don't find banks a particularly interesting investment theme to be involved with at all.
Why is it? That's really important. Why? I mean, just as a general theme, is it just there's too many banks?
First of all, rates look like they're going to stay high. So therefore, deposits are going to slowly bleed out of the system into money market funds, which means banks are going to have to remain tight, which means their growth is not going to be great.
Right.
The only positive thing you could say at this point is assuming there's no recession, credit quality will be fine. But that's not a story. It's not anything anybody's going to latch on to.
Do we have like another hour questions for Mr.
Absolutely.
Eisman? I think we do. Steve Eisman, thank you. We've got to get you back on here. Longer discussion. We never even got to private equity, private credit, and debt, and I really want to touch on that. Mr. Eisman is with a small shop, Neuberger Berman, an important investor. We thank Global Wall Street for your enthusiasm over guests like Steve Eisman.